What's up, millennials? If you know me a little bit, you probably know that I like numbers, I like Excel sheets, so that is exactly what we are going to do today. I want to present you a beautiful comparison between a few companies that you might like. We're going to take a look at ChargePoint, EVbox, and EVgo. These are all specs, EV charging specs even, and many of you have been asking for a comparison of these companies. So that is exactly what we are going to do. We are going to take a look at the valuations of these companies according to their revenue, their EBITDA. We're going to take a look at the amount of employees they have, the CEO, the experience he or she has, the amount of charging points that they have. So all of those things. So I really hope that you're going to like this video. If you do, please consider sharing this video with your friends who are also investing in EV charging specs. Before we start, a very brief remark though. I know that TPGY, so EVbox, and SBE, ChargePoint, are more or less in the slow charging space, if you will, and the new one, CLII, so EVgo, is more in the fast charging space. I'm not entirely sure if that matters a lot for the comparison we're going to do today, but it is something to keep in that beautiful mind of yours. So let's first take a look at the revenue of all of these companies. And just a little side note, I might actually say SBE instead of ChargePoint or ChargePoint instead of SBE. And I might do the same for TPGY and CLII and EVbox and EVgo. I might just mess them up a little bit, but hopefully you know what I am talking about. So here I posted the revenue numbers from these three companies from 2021 until 2026. All of these numbers, or actually almost all of these numbers, are just pulled straight from the investor presentations. In the case of SBE, so ChargePoint, we see that in 2021 they expect a revenue of 198 million, and in 2026 it should be a little bit more than 2 billion according to the company. If we go to CLII, so that is EVgo, we can see that they start off with a slightly low revenue, I would say, in 2021 of $20 million. And then in 2026, it is about $900 million. Then with regards to TPGY, so EVbox, we can see that they start off with 144 million in 2021. In the investor presentation, they go up to 2023. So I basically had to guess these three numbers of 2024 up until 2026, right? And I based that a little bit off the the revenue raises, if you will, of ChargePoint and EVgo. So hopefully I did a good job there. And as we can see in the graph, these revenue growth, these revenue numbers go up relatively the same, I would say, for all of these three companies. Of course, ChargePoint is up there a little bit more because they already had a head start as well, if you will, compared to the other two companies. And EVgo has the lowest revenue by 2026. And as I said, they also start out relatively low, right? Then with regards to the valuation of these three companies based on the revenue numbers, I just pulled all of these numbers straight from my YouTube videos with regards to all of these valuations. If you want a little bit more information about how I do these valuations, then just check out one of these videos I did for SBE, TPGY, or CLII, right? So as we can see, the Switchback Energy shares, well, the midpoint valuation there was $24.06. The current price per share is $38.03. So it looks like we are already above even the high valuation that I did in that video. If we go to TPGY, so that is EVbox, we can see that the current price per share is $27.50, but the revenue, the valuation rather, based on the revenue, the midpoint valuation was $38.37. So it looks like TPGY is still undervalued based on these numbers, right? And then if we go to CLII, so that is EVgo, we can see that the current price per share is $20.67, which is well above the valuations that we've done for this company. So it looks like only TPGY is actually undervalued right now, and both SBE and CLII are actually overvalued. I do have to say, though, that there are certain tailwinds that could make these prices be a little bit more reasonable, if you will. We now have the Biden presidency, of course. We see multiple countries banning fossil fuel cars, so that is going to stimulate EV adoption and also EV charging station adoption as well. So yeah, that could actually justify these prices for ChargePoint, for EVgo as well, but still that would mean that EVbox is actually even more undervalued. So I would say that TPGY for now is the winner of this section. Then what about the EBITDA multiples or the EBITDA numbers of these companies? Well, before we do so, I'm not sure if you saw this, but I ran a poll to ask you what kind of pronunciation you have of the word EBITDA or EBITDA or EBITDA or whatever. And most of you, or 46% of you, said that EBITDA is actually the correct pronunciation. 28% said EBITDA, 25% said what the hell is EBITDA, and 1%, so probably one person, said EBITDA is the correct pronunciation. All right, well, I'm not entirely sure if this is actually correct, but yeah, I guess I'm just going to go back to EBITDA instead of EBITDA then. Okay, so EBITDA. Let's take a look at the EBITDA numbers of SBE, TPGY, and CLII. And again, from 2021 until 2026. So we can see that ChargePoint starts off with minus 121 million EBITDA in 2021. And in 2026, they expect to have a positive EBITDA of $340 million. TPGY starts off with minus 96 million and goes to more or less 376 million. This again is based off my own expectations, basically comparing these numbers a little bit with the numbers from ChargePoint, because they only had the numbers up until 2023. So I basically had to guess the different numbers from 2024, 2025, and 2026, right? And then with regards to CLII, they start off with minus 58 million in 2021, and they expect to go to 331 million by 2026. Now, if you look at the chart, we can see that it is going to be very similar in the long term. These are all predictions, of course, keep that in your mind as well. And yeah, with regards to CLII, I kind of expect or suspect that they looked at ChargePoint and they said, well, let's use a very similar number, so we look just as attractive as ChargePoint does. And I also can imagine that you might wonder, how come these numbers are so similar, whereas the revenue is actually quite different? Because we just saw in the previous section that CLII is going to have way less revenue compared to ChargePoint and compared to TPGY, right? I'm just messing all of these ticker symbols and the company names up, but yeah, hope you still understand me. So the thing is, CLII expects to have a way higher EBITDA margin than compared to ChargePoint and also compared to EVbox. CLII or EVgo says we are going to have an EBITDA margin of 37% in 2026. Whereas ChargePoint says now we're just going to have an EBITDA margin of 16%. So that's a massive, major difference between those companies. TPGY is right in the middle. They expect to have more or less an EBITDA margin of 25%, right? So that is actually the reason why all of these numbers are so similar in the end. Now, I'm not entirely sure why there is such a big difference between those EBITDA margins, between especially ChargePoint and EVgo on the other hand. It might be because there are simply higher margins possible with the fast charging networks instead of slow charging networks. I'm not entirely sure. If you have any idea, let me know. It could also be that the EBITDA margin of CLII of EVgo is simply too high, or maybe ChargePoint's EBITDA margin is simply too low. I'm not entirely sure. So again, if you have any good questions, if you have any good comments about that, then please let me know. And then if we look at the valuation of these companies according to the EBITDA numbers, we can see the following actually. I just used the method that was provided to us by CLII and EVgo, and I applied that same method to TPGY and to SBE as well. So according to this method, the fair midpoint price per share for CLII would be $22.83. Current price is a little bit under that. So according to this valuation, CLII is actually slightly undervalued. If we use the same method for the other companies, we see that SBE would have a midpoint valuation of $20.42, whereas the current price is, of course, way above that. So it would be massively overvalued. And if we take a look at TPGY, we can see, well, pretty major increases, a midpoint valuation of $64 almost, whereas the current price is $27.50. So again, I think that TPGY is still the most undervalued stock of these three. And I think that CLII might be properly valued, maybe slightly undervalued, slightly overvalued, but probably good. It's probably properly valued, and SBE still, I believe it might be overvalued, but again, keep in mind those tailwinds I was just talking about. Now I'm just going to share with you a few brief interesting facts about all of these companies. Let's first of all start with the amount of charging ports that have been delivered by these three companies. So if we start with ChargePoint, we can see that they have delivered 134,000 ports right now. If we go to EVbox, we can see that they have delivered 190,000, so a little bit more there. And if we go to EVgo, we can see that they currently have a little bit more than 1,400 charging ports, fast chargers in their case. So we can see that here also TPGY is the clear winner. Then we have ChargePoint, so SBE, and then we have CLII, so that is EVgo. I also looked at the years of experience that the company has. So for this, I use a website called Grojo. I didn't know of it, but yeah, I just found it today. If you have a better website to track this kind of information, just let me know in the comments, because I would love to find a company, or find a website rather, that can actually track this kind of information. But yeah, for this one, we are going to use this company or this website called Grojo. So first of all, the years of experience of a company, basically when the company was founded, and then the amount of years that they have so far. So we can see that ChargePoint, for example, was founded in 2007. So that means they have almost 14 years of experience. EVbox was founded in 2010. So that means they have a little bit more than 11 years, or almost 11 years of experience. And also EVgo was founded in 2010. So that means that also this company has 11 years in experience. So basically that means that, well, there's not a large difference, of course. ChargePoint is a little bit more experienced, I would say. But yeah, it's not a major important factor, I believe. Then let's take a look at the number of employees these companies have. Well, first of all, ChargePoint has 737 employees. I'm not sure if this is entirely accurate, but it's the most up-to-date number that I've been able to find. EVbox has 673 employees, so a little bit less compared to ChargePoint. And EVgo has 147 employees, so that is quite a bit smaller compared to the other two companies. Then I thought it would also be interesting to look at the amount of job openings that these companies have, to see how quick they need to grow or how quick they want to grow, right? So with ChargePoint, we can see that there are 77 job openings. EVbox has 35 job openings, and EVgo has only 1 job opening. Very difficult to say. So we can see that ChargePoint is actually trying to hire the most people, TPGY a little bit less, and CLII, yeah, just very little, to be honest with you. And then the last thing that I would like to share with you is the amount of experience of the CEO of these companies. We can see that the CEO of ChargePoint, which is Pasquale Romano, he's been at ChargePoint for about 10 years now, so he's already got a lot of experience. Then the CEO of EVbox, which is Christophe Reinogen. Sounds very weird to say that in Dutch because I'm not used to saying that in Dutch, but hey, here you go. He's been at the company for 6 years now. And if we take a look at the CEO of EVgo, which is Cathy Zoy, she's been at the company for about 3 years. So we see that the CEO of ChargePoint has the most experience, then the CEO of EVbox, and then the CEO of EVgo. So there you go. I just wanted to show you some interesting facts so you can actually decide what you are going to do with these facts. However, if you want my personal opinion, well, I'm going to give it to you, because I think that ChargePoint and EVbox are more or less on the same level. They've delivered many charging stations. They've got a lot of experience. The CEO has a lot of experience as well. We saw relatively similar revenue numbers, relatively similar EBITDA numbers as well. They are hiring quite a lot. And we've also seen that, well, if you compare these two companies, TPGY, so EVbox, is the most undervalued one. Then with regards to EVgo, we saw that this company was actually usually the last option, the third option of all of these items, all of these sections we have been talking about. So it's not my favorite EV charging stock per se. I'm not holding any position in EVgo. I do have positions in ChargePoint, so SBE, and also EVbox, so TPGY. But yeah, again, this EVgo company is usually the last option. I'm not sure if that is because of the fast charging versus the slow charging. Could be the case, I'm not entirely sure. We did see, of course, that EVgo promises to have a very high EBITDA margin in 2026. If they actually manage to do that, that would be beautiful for that company. But I'm not entirely sure if that is actually going to happen. Okay, I hope this video brought you some kind of value. If it did, please consider sharing this video with your friends who are also investing in SPACs. If it did not, please let me know in the comments why it did not. Please let me know all the feedback you have so I can continue to improve on my journey. With that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye.